Welcome to today's panel session. It's going to be a discussion around how FIs are managing the emissions associated with their financed activities. My name is Simon Atherton. I am Climate and Investment Research Lead at Standard Life, and I am also the UK chapter lead for PCAF currently. I'm joined on stage today by colleagues across the industry from a range of different financial institutions. So sitting just to my right is Hetal Patel from Standard Life. We then have Zach Risby from Coventry and Co-op Building Society. Then we have Hilka Komalainen from Quinbrook. Then we have Ian Bueller from UK Finance. And we have Haiji Kim from British International Investment. I'm going to hand over to each of my colleagues now to give a brief introduction to themselves, their institutions. I'll hand over to Hetal first.
Hi, afternoon everyone. Great to see so many of you. So Hetal Patel, I wear two hats. So with my first hat, I head up Sustainable Investment Research at Standard Life, so in the same team as my esteemed colleague Simon. Over there, we think about the frameworks in which we invest. So we think about how we assess sustainability, how we measure emissions. We think about what sustainability objectives we want to set ourselves, and how we integrate sustainability into our investment portfolios. I also, with respect to PCAF, I chair PCAF's core team, so that's the committee responsible for governing and developing the PCAF standard. That's where we set out the PCAF methods.
I'll hand over to Zach next.
Thank you. Afternoon, everyone. So I am Zach Risby, only the one hat. I am a group Sustainability Senior Specialist for Coventry Building Society and also the Cooperative Bank. The Coventry Building Society brought the mutual ownership model to the original ethical bank last year for the first time. So we primarily deal with mortgages, but also savings, business banking as well. We're at a pivotal point, obviously, because we're bringing two organisations together for the first time. So a lot of what we're doing is reviewing our financed emissions management and measurement, of course, looking at the best of both worlds. So it's very topical for us right now.
All right, good afternoon. Such a pleasure to be here. Thank you so much. Hilka Komalainen. I'm the Global Head of Sustainability and Impact at Quinbrook. We are an energy transition infrastructure investment manager. We're an asset creator and a business builder, so that means we bring new renewable energy and energy transition infrastructure assets online. I lead all of our sustainability work. That includes our approach to emissions measurement and accounting, but also sit on our Global Investment Committee and co-chair our Procurement Committee.
Hi everyone, Ian Bueller, Director for Sustainability at UK Finance. I'm really glad to be here. UK Finance is one of the trade bodies for the financial services sector in the UK. We represent about 300 firms, including many of the high street banks that you'll be familiar with, as well as international and UK headquartered investment banks, commercial lenders, retail lenders, as well as building societies and payments firms. And I head up the sustainability work on behalf of the industry for UK Finance. That includes advocacy on achieving the policy and enabling environment that will help our members to invest in and lend to the transition, regulatory advocacy and knowledge sharing across that cohort of members.
Great, thank you. Hi everyone, I'm Haiji Kim from British International Investment. I work in the climate change team as an executive. I'm very happy to be here to really join you guys. And in BI, we are UK Government's Development Finance Institution. So we invest across Africa and Asia. We partner with businesses and private sector to make sure our investments are creating development impact in productive, sustainable, and inclusive way. In the climate change team, we really try to measure the climate impact coming from our investments, which would include the greenhouse gas emissions accounting, of course, but also adaptation and resilience, and so on. So we're very happy to be here and excited to share our experience. Thank you.
Thank you, Haiji, and thank you the rest of the panel. So just before we get into a few questions, for background, obviously PCAF is a body that has developed a global standard for financial institutions to measure the emissions that are associated with the activities they may be financing. So bearing that in mind, we're going to have some questions about what you can use this standard for and how the respective institutions on stage have gone about that. So the first question will kind of open things up. So what has the ability to measure financed emissions now enabled you to do that wasn't possible before? And I think we'll start with Hettel on that one to get your thoughts.
Sorry, I'm squinting. I could really do with sunglasses. I wasn't quite expecting the floodlights there. So everybody has heard of the saying, what gets measured can get managed. And so really PCAF is an enabling layer. Financial institutions, whether you are an asset owner, whether you're a bank, you're an insurer, asset manager, you will find that the biggest part of your carbon footprint, your profile, sits in your what we call category 15 in your investment portfolio, your loan portfolio, if you're an insurer, what you're insuring. And so having a clear and comparable method in which to evaluate your portfolio emissions is essential to taking action. So it's the starting point for which any financial organization can assess its emissions inventory, and then on that basis can then set about strategy. So whether that's investing in avoiding certain sectors or trying to invest more in certain renewable low carbon areas, or designing products that will help achieve that. But that's your starting point. And also PCAF then gives you very clear guidelines around how you report that. So it then creates a level playing field for which interested parties can look at different providers or different financial institutions and be able to compare in a kind of clear manner. I'd also say, look, PCAF is an important part of the financial ecosystem. So we have other organizations like SBTI, which gives guidance around target setting. They require a basis, a language in which to talk, and so they reference PCAF. And so PCAF is very important as being an enabling layer as part of that ecosystem.
Thanks, Hettel. I think I'm going to bring Hilke in for a few thoughts from her on this one.
Yeah, what has measuring enabled for us? I really want to turn this kind of narrative that we often have when we talk about emissions as like you're trying to decarbonize and you have a portfolio and you identify where you have the highest emissions in your portfolio and you go and talk to them. For us, the first key aspect that this has enabled is actually identifying investment opportunities. Now, what do I mean by that? We will look at things like, as a renewable energy and energy transition specialist, when we are building solar or batteries or industrial decarbonization projects, we will look at things like the carbon intensity of the grid. Is there a need to decarbonize? That is where you'll find opportunity. Do you have off-takers in that area that either need to decarbonize because they've made net zero commitments or renewable energy targets, or they've made commitments to buy offsets for all of their power, something like that? That helps us identify where to put our projects and whether or not we'll be able to find an off-taker that is a big part of generating our investment return. It's also a guide to what does the transition need? What are the parts of the economy that we need to decarbonize? We do a lot of work across our supply chains on traceability and modern slavery. That has allowed us to actually think about what are the components of the supply chains that we use. Batteries, for example. Where our batteries come from, where the battery metals and materials coming from, what does the supply chain look like? And has led us to realize that actually a lot of the supply chains of all of the things, batteries, solar panels, wind turbines, electrical equipment, are incredibly carbon intensive. That has actually led us to completely rethink our investment strategy and identify opportunities for creating investments in green materials, creating investments in industrial decarbonization. So there really is an opportunity angle that I would like to highlight. Can I just get a show of hands? Who here has heard of, is familiar with the EU Carbon Border Adjustment Mechanism? Okay, a few. Effectively, that's a carbon tax that the EU has implemented for imports of goods that are incredibly carbon intensive. That is a guide for all investors, not just us, to think about where do those supply chains need decarbonizing. We're starting to have much more and more of this awareness, and that starts with measuring your emissions and understanding emission intensity. The second thing that I want to highlight of what it has enabled for us, or continues to enable every day, is client service. Our investors need emissions measurement, need emissions data for their own internal processes. Larger financial institutions, like many of my colleagues here on the panel, will need that information to go, what are the hotspots in my portfolio that allows them to think about their investment strategy, and that is a really big part of being a successful business. Please your clients.
Thank you, Hilke. And Ian, what are you seeing more broadly across the UK financial landscape?
Yeah, thanks, Simon. I guess the first thing I'd say is I fully echo Hilke's point about opportunity generation and opportunity identification. I would almost think of financed emissions reporting and measurement as an indicator or a means of setting out the delta between where we are now on emissions trajectories and where we need to be based on either what the policy landscape expects or what the strategy and intentions of the company are. So there's this very concrete measure for where you need to get to, which can translate into a financing opportunity, which is where it's so important for financial services firms. The second point I would like to add, based on conversations I've had recently with firms, is that it's important to recognize that financed emissions measurement is not a one and done process, and it's a long process. And actually, in engaging with firms and understanding their emissions portfolios, there's the opportunity to deepen your wider engagement with firms on their transition trajectories. This is not just about understanding that single metric, what your emissions looks like. It's understanding the long-term trajectory and even getting into conversations about transition planning and beyond. And then finally, I suppose one not word of caution, but a factor to consider when thinking about financed emissions as a mechanism for emissions management is, I suppose it's one among many metrics, and Hettel, you hinted at this with your reference to SBTI. Many of our members report a range of metrics in thinking about and demonstrating their progress on their sustainability targets, and that might include also things like sustainable finance targets and sustainable finance deployment. And I think that reveals that there is still a wide range of potential ways for evaluating and setting out your success in delivery of climate targets. And we're here on the hottest day of the year. We know that we're facing a climate crisis that's becoming ever more obvious to us, and we need every possible tool available, including different metrics.
Thank you, Ian. So I think one of the things that's clear that sort of underpins all of this is the need for data and the need for accurate data. So in a world where data is sometimes imperfect, I was going to ask Heiji, sort of how do you deal with imperfect data, and sort of how can you overcome that and ensure that it's sort of credible and transparent?
Great, thank you so much, Simon. Yeah, so from BI's perspective, a lot of the economies and markets we invest in have lack of data, lack of resources and capacity to be able to measure emissions. So really the perfection isn't the starting point. We start with imperfect data, but what's really important for us is for our credibility is to really transparently disclose what has been measured against what has been estimated, and really lay out what are the gaps that you're trying to fill out, and if any reliance on proxies that sort of you'd like to caveat in your greenhouse gas emissions footprint. So I think it's really the journey. We tend to work a lot with our investees to really improve the data. It's also a positive story to show to the stakeholders that how you're improving the data using such as the PCAF data quality score, which provides a really common good ground in ways to do that. And also, finally, I think it's really to highlight that this is a journey. I think a lot of our colleagues would highlight, based on materiality, based on sort of where your hotspot is coming from, you might want to really start engaging the investees and also have a time to really help them to build their capacity and could provide support in many ways that could be both beneficial for both sides. So I think it's really, as a BI, we provide technical assistance to lots of our investees, and we also felt that in the markets that we operate in, there's not lots of granular proxies out there in order to estimate jobs and emissions. So BI, together with FMO, which is a Dutch DFI, we partnered to develop joint impact model, which helps us to really gain more insights into the African markets, the Asian markets, to really help us to improve the credibility of our emissions footprint. Thank you.
Thank you, Heiji. We're going to bring Zach in on this one now. I think with a more sort of retail-orientated, large loan book, it must have some different challenges there.
Well, I mean, you'd think so, but I think one of the really reassuring things about finance emissions is actually we're all facing really similar challenges. So, what you said there, Hedgie, really resonates strongly with us as a retail lender, with primarily dealing with mortgage books, completely different operations and lending portfolio to you, and yet perfection isn't the starting point. That is a big tick for us. I guess not a big tick. We'd love perfection, but we're not quite there yet. To give a very real example, we at the Coventry Building Society, as I mentioned, merging with the cooperative bank, and we were comparing our portfolios last year, mortgage data specifically, and we found we used completely different methodologies, even though we're very much the same industry. And the PCAF data quality scores were almost identical, really similar. So what I'd say is the differences are much less stark than you'd expect across finance. I think what Hedgie said there, though, and for me is the most important thing, is that you can be credible and have completely different estimation methodologies and still come to equally credible outcomes. So, if you're disclosing, being really honest about your limitations, being clear about how you can improve, and not just disclosing that internally, but putting it out in your reports, you end up getting to that credibility through transparency. It's not so much a balancing act in that sense.
Thanks, Zach. Yeah, I mean, I think that's key to all of it, isn't it? It's understanding on what basis the numbers have been produced and disclosed, so that you've got that ability to make decisions. I'm just going to bring Hettel in just for a few final thoughts from more of a pension and life insurance perspective.
I'd say reinforce some of the points just made there. Very much, what I talked about earlier was what gets measured gets managed, and we're all on this journey. Climate data isn't perfect, and that means the key being, if you don't make a start, you're not going to get on your foot into that journey. And the point of PCAF coming up with the data quality score was to provide transparency. How much credibility is there behind this data, and to make sure that the users of that information have a good sense of how credible the organization putting numbers out there are. So at Standard Life, we have a large public book, which means we have literally tens of thousands of listed counterparties, but we also have now a growing private book as well. And we have two very different challenges with data quality when it comes to the two sides of the book. So for our public book, we very much, because of the sheer volume of counterparties, we rely to a large degree on data vendors, intermediaries, in terms of gathering information. And now the PCAF data quality score is become well enshrined in the ecosystem, that data vendors even put a data quality score. So that reduces some of the workload that we have to think about. But of course, with our most significant exposures, we do look beyond just data vendors, and we do think about how credible are these numbers themselves, and what do we do on the back of them? Should we be having that level of exposure to that counterparty? Do we engage with them further? But that to us is the slightly easier part, because there is also very good data coverage. But when it comes to the private side of the book, you can get involved in a project which is funding a project which is completely novel, there isn't any history of data, and so then you have to think about, well, what is comparable? What could I compare it to? Think about the average emissions for the sector, and so you have to estimate. And the PCAF, you go back to the PCAF data quality approach in terms of conveying that score. The one thing I'd say is, whilst I think we're doing a good job of managing our emissions and making our way through the journey, I think we can all do a better job of actually trying to manage the data quality. In terms of what I haven't yet seen are plans. I've seen plans for transitions, but I haven't seen clear plans of how are we going to improve data. And that's something that I think industry, one step at a time, that industry will start thinking about soon.
Thank you. So I think we've heard a little bit there about sort of how you might approach the problem of credibility of data and accuracy and so forth. So once you've got some accurate data to work with, what sort of internal shifts have you seen within your organisations that allow this to become more than just a reporting exercise? And I'll throw that one to Zach first.
Yeah, absolutely. Well, for us as a mutual, I feel like I keep saying that over and over again, it's probably a bit easier than some of the rest of you, and I don't know about yourself sitting in the audience, to convince people internally, because our most important stakeholders are our members, who are also our shareholders. But I'd say that's not really the most important part. The biggest shift we've seen, and I'd be interested to get an idea of the room of how many people sit in sustainability teams or in central sustainability teams. We're going to just get a show of hands if you are. Less than I thought, so maybe this won't be as controversial as I was expecting, but the biggest shift we saw was taking responsibility away from the central sustainability team for financed emissions. Essentially what we found is that after first starting out at least, we'd do the reporting, we'd do the calculations, we'd end up with a number, we'd put it out there, and we'd sort of move on. And that's not because there was no appetite to decarbonise or manage those emissions. It's a mammoth task, I mean, we sometimes call it the elephant in the room, the financed emissions, and hopefully I'm not the first one that said that today. And what you find is that with financed emissions specifically, and the calculations that you carry out, they are almost all entirely sitting as a result of the activities of the products that you're releasing, especially as for us as a retail bank. And so why not move the responsibility to the people who actually can make decisions and truly take action in that space? I think we're still at the beginning of that journey, moving responsibility for something like financed emissions to a different team comes with a load of other hurdles, and I think governance and accountability processes need to be changed. But as long as what you're doing is embedding into existing processes rather than trying to develop wholly new ones, what you end up with is people that might not be responsible for sustainability every day, but they know products like the back of their hand, they know finance, and you can't do much with financed emissions if you don't know finance. So, yeah, the biggest shift ultimately is taking it away from the people that feel like they might know it the most, but giving it to the people where I think historically the responsibility should sit. I guess that's time will tell whether that's the right move, I guess.
Thanks, Zach. Yeah, I think that's probably a trend that you might see across quite a lot of organisations recently and continuing, and I'm sure Ian will probably have some thoughts on that.
Yeah, definitely. So we, as UK Finance, over the past couple of years have had a long-running relationship with the NGO RMI, formerly the Rocky Mountain Institute, bringing together, at the moment, about 20 of our members, the largest sort of investment banks, among the largest investment banks globally, as well as kind of wholesale and corporate lenders. And the question that we ask in that forum is, what are the barriers to mobilizing finance for the transition, essentially for your emissions management processes. And it's a group of sustainability folks. So to those who just raised their hands, you're equivalent to some of those organizations. And I can't see all of you, but maybe even some of you are in that group. And one of the questions we've been asking recently is who are the stakeholders you're having to engage within the business to affect change and to mobilize capital? And it's just so hard to overstate how many different stakeholders people are having to engage. It's everything from, as Zach just said, your front office and product development folk through, and I'm looking down to check because it's a long list, risk and credit committees, legal, marketing, business strategy, compliance, internal audit, and I'm sure I'm missing a huge number of others. And so I suppose one of the key shifts is just managing to engage with that huge range of internal actors to unlock the activity that you need to address your emissions in the portfolio. Drawing again on what Zach said, one of my reflections from all of that is it's really clear that front office and client engagement leads are absolutely critical, because I suppose when we're talking about financed emissions, the real mechanism for influencing emissions in the real economy is through clients, and framing the emissions management process in a way that actually appeals to those people who are, when we're being hard-headed about it, ultimately focused on delivering a profit for their firms is really tricky. And I know a lot of you and a lot of organizations within our membership struggle with conveying that messaging and ensuring that the need to manage emissions down is framed in a way that resonates with those objectives. The last thing I'll say is I suppose one of the key shifts has been deployment of transition plans, and particularly developing transition plans, which, as I understand it, is an incredible mechanism for engaging the whole business and getting buy-in. I'll stop there.
Thanks, Ian. And Hilke, obviously you're quite heavily embedded in the actual investment process. So does it differ there, or do you use similar sort of circumstances?
Same, but different. I really want to echo the point made by multiple people here on not letting perfection be the enemy of the good when it comes to emissions data. I would just generally question that about any data. If you've gone deep enough into any model, any financial data, you'll be like, there's always room for error somewhere. And I think we should apply that kind of 80-20 rule to financed emissions data as well. I will say, though, that the three internal shifts I want to flag of what has changed how we look at this. Firstly, having the quality of data that when I present it to my colleagues or investment teams, it resonates. It's actually incredible. Usually they are very switched on, and if the data that we've collected doesn't reflect their understanding of the reality, they switch off immediately. So having quality of data, standardization across the portfolio, obviously then being able to use that for target setting and analysis and things like that. Second one is having sustainability as part of our investment decisions. I'm a voting member of our investment committee that is inscribed into our processes and organization, and that allows us to have conversations at investment committee level, not just kind of strategy or origination level of like, do we have a thesis for the transition? What does that look like? And make sure that it's actually communicated and verbalized. Oftentimes I'll find my colleagues are thinking about it, but actually putting some kind of measurement and documentation around this. The third one, which is maybe a little bit surprising to bring up in a PCAF panel, but in our business model, it is incredibly important, and I do want to highlight this for everybody. We used to model future projected greenhouse gas emissions from our project at the point of making an investment. Our life cycle is simplified. We buy a piece of land, we get all the permissions in place, we hire a construction company, and we build a solar farm, or a wind farm, or a battery, or solar co-located with batteries, or an industrial decarbonization project, a green data center, an electric vehicle charging station, or fueling station with clean fuels. Anything we're going to estimate at the point of kind of initial decision and do we buy the land is going to be incorrect. It's a projection. And actually we found that getting our investment teams to do that exercise again, thinking about what does it mean for them, not completely a waste of time, but wasn't anywhere near as material as the energy transition thesis. Is this going to generate avoided emissions? What kind of grid are we in? So the avoided emissions aspect and getting that right, it is something that I think we don't talk about enough in the kind of emissions measuring and monitoring circles. I think it's seen as a bit of a pseudoscience. At the same time, this is really what we're trying to achieve, aren't we? If you're thinking about what we're trying to do in our portfolios, like yes, we're trying to decarbonize, we're trying to avoid there being more emissions to exacerbate climate change, and certainly in our business model, where we're bringing on board online new, additional, impactful climate infrastructure, you want to have a climate change impact. How do you measure that? That avoided emissions impact, whether we put a number on it or not, articulating that in our investment decisions has been a big internal shift that has allowed us to focus.
Can I just jump in and add something there? I heard something somewhere else this morning, and it really resonated with me. And it was a sustainability professional, and he said, really, I don't want there to be sustainability to use because I want every business decision just to think, capture the sustainability thinking within it. And so when it comes to, it might be bad news for all of us, but, this is where we're headed. And I see within our own firm, our colleagues who are frontline investors, at one point they used to come to us and ask us to calculate the numbers. Now they do it themselves. And so where we want to go, where PCAF is trying to give people the tools, investment professionals, not just say, turn around to sustainability colleagues and say, can you help us, to actually, become self-starters and start calculating and thinking of this as just part of the investment process.
Just to reassure everyone, I think we'll all still have a job. There's so much complexity and technicality when it comes to new technology and other things. No one panic.
It'll be a while yet.
Thankfully. So I think what we could say is obviously we've reached a point now where maybe we've embedded this thinking into what our decision-making process is. So it might be quite nice to talk to a couple of real-world examples where actually having that insight into emissions has helped influence decisions. So, Hilke, I think you've probably got a couple of examples to talk to.
Yeah, lots actually. So the deals that we make and invest in, oftentimes the value of our offtake contract, which is what allows us to manage risk. You build infrastructure and you want somebody to buy the energy or the capacity of the battery or the clean fuels that we generate. Oftentimes the value of that contract is somehow linked to the carbon intensity of the product. Let me give you a couple of examples. Clean fuels, carbon intensity of a renewable natural gas or a biodiesel is actually really instrumental to determining the value of that fuel to the customer. Similar in the data center space, you've got clients that have, we work with a number of the hyperscalers through our data center business, Rowan. A lot of them will have targets around renewable energy procurement. They'll have targets around carbon intensity. They'll have targets around net zero. They've said that they're going to offset all of their emissions from their data centers. Data centers, as you all know, is a hot topic in pretty much every market. The carbon intensity of the product will determine the amount of money that they're going to have to spend on offsets, will determine the operating emissions of a data center. Same thing actually with batteries. We have developed a software called QuinTrace, which effectively allows you at the point of actual operation at the specific node to match on an hourly basis the battery or the generation with whatever is happening in the grid. So both measuring the carbon intensity of the product as well as the avoided emissions, that actually generates really useful data, both for us to ensure that we are within our target market and we can get the best offtake price and the best return, as well as for the customer, for them to understand how do they need to manage that within the context of their net zero targets or their renewable energy targets or their emissions reduction targets. The other part, I think here is the climate impact from the point of view of our investors who are choosing to invest with us. we report our emissions as well as our avoided emissions on a quarterly basis. We do get a lot of questions from our investors going, why does it fluctuate? Again, in our business model, the emissions impact will be determined by the life cycle of a project. So when we're in constructions, emissions are high. When we stop construction, usually you get net zero or close to net zero, and enabling assets who have much lower emissions profiles. So our emissions naturally fluctuate, and being able to have conversations around that, it matters to investors. There is something that we need to manage closely.
Thank you. So I suppose just replaying that then, so it's quite important to have, an equivalent sort of counterfactual for comparison purposes with decision making.
Yeah, and that's part of the reason why we developed QuinTrace, because it allows us to look at these very, very granular decisions. Everyone always says that avoided emissions is, something that you estimate based on this is where the grid is today or where it's going to be. It allows us to actually get traceable and verifiable data on what exactly happened at a given hour on a given day. It also allows you to match things like when's the best time to charge my battery or to charge my EV. If you're looking to optimize from a carbon footprint perspective. So it just gives you that granular level of data to actually manage what is happening. And ultimately that comes down to emissions measurement.
Brilliant. And Heiji, do you think about things in a similar sort of way at BII, or a slightly different approach?
Definitely. I think I really resonate what Helka has said, like feeding into the IC papers, building evidence and what sort of the financed emissions would be generated from the investment and so on. So I want to give a bit more background to DFIs or impact investors that might be in this room is more like as a DFI, we have multiple impact objectives that we want to achieve, as well as the financial returns. And in terms of impact, it's productive, sustainable, and inclusive. And then the greenhouse gas emissions accounting, in terms of the generated emissions or avoided emissions, both feeds into the sustainable score that we give to each investment. So we can really look across the portfolio and pipeline and really see which are the investments that sort of ticks, gives the most impactful investment in terms of the three dimensions that I have just mentioned, so that we can make a very holistic investment decision. This is because as DFI we provide concessional capital, so we want to really maximize our impact where the concessional capital is going in. And also the second, I think, use case that I'd like to bring up is really the senior management monitors on an annual basis where our finance emissions at the portfolio level are standing, so that we are on the trajectory to reach the goals of the Paris Agreement. But at the same time, I think we really want to lean more on real world decarbonization efforts. So it's really about, I think, because there are some sectors like food and agriculture or heavy manufacturing that is really essential for economic development, especially in the context of the markets that we are investing in, and we cannot just shy away from that because they're standing at a high emissive starting point. So we want to really know where our investees are standing at, how they're benchmarking against the best peers, and really can we think of ways to bring them in and engage them, provide solutions in terms of financing, or could be the knowledge, and provide maybe also the technical assistance program. So these are the ways I think because you understand the footprint of the investees, you can really think of ways to find the opportunity side in terms of transition finance or transition planning and so on.
Thank you, Heiji. And just to bring Zach in on this, I guess maybe slightly different challenges with the residential sort of mortgage book than some of the impact and sort of infrastructure investments.
Yeah, very different. The Coventry specifically, we work more on volume. I guess it's fair to say. That's definitely not claiming that it's quantity over quality. I'd definitely get in trouble if I said that. It's a case of we're not looking at individual mortgage decisions when we're looking for real examples. So I think the easiest way to look at it is, again, I mentioned product before. It's product and proposition development is how we use those insights. So obviously financed emissions calculations give you an idea of what the areas of your book are most carbon intensive. So the real way we use that is prioritization. To put it simply, where do we start? Because you've got that elephant in the room. What end are you starting at the head or the tail? So if we look at our portfolio as Coventry for the group, once we had the hard numbers, we were able to direct conversations around green proposition development, much more specifically around customer segmentations that we could identify and had identified through the product team to do. You do things like marketing. Segmentation is obviously very important for any sort of commercial or retail bank like us. And our portfolio, slightly different to maybe some other lenders, has a higher proportion of buy-to-let mortgages. So they're still residential, but products where the house is owned by a landlord. And what we actually found is that those products have a lower attributed average emissions than a typical traditional residential residential mortgage, owner-occupied, is what we call it. And these insights are kind of fairly intuitive to start with, but you need the data to actually back up the decisions we're looking to make, which is how do we treat landlords differently to a residential owner-occupied mortgage, and how do we use those insights to develop different credible transition pathways for those different sets of customers, because you're in trouble if you're looking at all mortgage customers as one big group, because they're not the same. They don't make decisions in the same way. Their incentives are completely different. And that's also likely why the emissions on average tend to be different, because they are different products. And so what we get instead is insights that lead to different product pathways, different proposition developments. And although this is very pertinent, we're in the process of doing this still. We're much further along in our journey now. We understand that we are using that data to inform different pathways, as opposed to doing that grouping, which I think is quite dangerous at times.
Okay, so fairly fair to say then that granularity of data is quite important, whether it's at a sort of singular asset investment type level, or whether it's across different customer segments, different behaviours across your balance sheet. So we might just take a slightly forward-looking view now. I'm going to bring Ian in on this one. So what do you think the sort of the next major challenges are going to be for the industry as expectations continue to evolve over the coming years?
I might be very cheeky and say, first of all, that I don't think we've overcome the existing challenges. And I'm sure many in the audience will agree with this, and we've already heard this, I think, from everybody on the panel. There's a widespread acknowledgement that financed emissions reporting still has a long way to go to get even close to high quality or perfect. And just to give a few examples of that I hear within our membership, if you're a mortgage lender, you're often still very reliant on patchy energy performance certification and modelling off the basis of that as a basis for measuring your financed emissions, where EPC certificates are often not up to date and may not exist for many properties. If you're a commercial lender, you'll be very reliant on estimates of SME, small and medium-sized business emissions based on either sector estimates or other proxies, or sending out often unfortunately quite onerous and tricky surveys to your customers who may not be well qualified to fill them out. So there's a lot of stuff to go to happen to improve the existing landscape, and I think it's important to say that there's lots of work underway to address that. Things like Project Perseus, which is trying to improve the flow of emissions data from SMEs and households to lenders, and lots of commercial offers that are ever improving. But in terms of future challenges, I guess the key one, I'll split it into regulatory and political. On the regulatory side, this is an incredibly active year for the sustainability reporting world, and included within that financed emissions, the Financial Conduct Authority here in the UK has just consulted on rolling out new sustainability reporting standards or reporting expectations against the new UK sustainability reporting standards for listed companies, and we're expecting to see similar work for non-listed companies, and included within that is probably the first provision we've seen in the UK of some form of mandatory or comply or explain requirements to report on Scope 3 emissions, including financed emissions. So the regulatory environment is moving fast in this direction, and those expectations will increase the need for firms to get set up. And likewise, banks and insurers are now implementing the Prudential Regulation Authority's enhanced climate risk management expectations, which, while they don't explicitly include a financed emissions reporting expectation, for many firms, having a good handle on your transition risk may mean having a good handle on your financed emissions. So lots going on in the regulatory space. I guess just finally, politically, if there's one challenge I'm most mindful of, it's the fact that we've made a lot of progress in this area. Clearly from this conversation, there's a wide recognition that financed emissions collation is offering value to firms, but we're also looking at a lot of political instability at the moment, as this week has shown, and potentially more in the future. And if the precedent from the US is anything to go by, we could see pushback on a lot of the progress that we've made in developing capabilities across the economy in reporting emissions, which many financiers rely on. So we'll be watching that very closely and continuing to communicate the value that we see in the progress we've made so far.
Brilliant, thank you, Ian. I'm just going to bring Hessel in now, maybe firstly from a financial institution perspective, but also perhaps a little bit with your PCAF core team hat on. I'm sure you've got some things you're thinking about for the future.
Well, just start by saying I think of myself an optimistic person, so I'll take a slightly glass half full, a bit more of a positive approach than Ian. And I'd like to think that the financial sector has come a long way, and that we've done a reasonably good job of getting our arms around the challenge, the problem. There's a good degree of reporting happening already. Is it perfect? No, absolutely not. I would say, look, the bigger challenge I feel isn't so much that we are missing, there's, for the main asset categories, that genuinely, you follow PCAF principles, like, think about what you're financing and what the emissions are associated with that. It's called follow the money principle. We're doing a reasonably good job of reporting on that, having an understanding of the emissions associated with that. The bigger challenge to me is around, we've made progress, but what are we actually achieving? PCAF is meant to be an enabling layer. And are we really taking the actions that we want to? So how many people are from a financial institution? And how many of your institutions have seen over the past few years your emissions profile come down? I see a few hands up. And how much of that is down to the fact that actually it's just because asset prices went up? Versus perhaps you change your exposure and you're holding less or insuring less of carbon intensive names, versus who actually managed to take action and found the most intensive names and got them to change practices and to bring emissions down, or were able to bring down emissions because you ended up funding projects which were low carbon, bringing about change in the economy, which otherwise couldn't have happened. So, as I went along, the latter things have a more significant real world impact. But how much of that is coming through in your reporting itself? I'd say for most people, it's not. It's just a headline number that's coming out. So what I feel is missing, and this is something that PCAF is thinking about with my core team hat on, is about better attribution analysis. Only then can people really understand, well, this firm really had this impact on the real world, and not just outside people, it's for management themselves. Are we achieving what we're setting out to do, or is this just being washed up by other factors? And so that also goes to the credibility of PCAF by making sure that changes are we're transparent about what the drivers of these changes are.
Thank you. And I think that ability to attribute and sort of see what has actually happened in the real world and the change that you may have affected is something that's sort of come out today as being a clear goal for everyone. And I know we're just going to wrap up on this question very shortly, but I'm sure Hilka has one or two bits she maybe would like to add.
Yeah, if I look forward, I think we need to get a lot better at segmenting what we're doing into the emissions that we want and the emissions that we don't want. Getting asked questions about decarbonization targets when you have a solar developer, for example. You want more solar, not less. Building does incur emissions, and it has this massive, massive, massive climate impact beyond your own kind of, GHG protocol language, beyond your own scope and beyond your own boundaries, and differentiating between that and decarbonizing heavy emitters, heavy industry, etc. The renewable energy generation and other decarbonization levers is what is going to enable them to decarbonize. So looking at that difference between scaling up climate solutions, financing and investment, and decarbonizing sort of the legacy economy, if you wish, number one. Number two, and this is a very, not just glass half full, but glass brimming over, there's never, ever been a better time to invest in the energy transition. We should be excited. We should be going at it hard. This is a time when geopolitics is behind us, energy security is behind us, the economics are incredibly beneficial. Oftentimes, renewable energy will have the lowest cost, levelized cost of energy. We should be looking at this as a massive opportunity, and rather than always getting bogged down in the things that are not working.
Brilliant. And I wholeheartedly agree with that. I think PCAF gives you a really solid starting point for being able to do that and take that action. So we're just going to wrap up now with one final question. Almost a little bit of a rapid fire one. So I'm going to ask each of the panel members just one final question. Everybody gets the same question. And that is, so for institutions who are earlier on in their journey with PCAF and their emissions management, what's the one thing that you wish you had learned sooner that might be beneficial for others to know now? And I'll start at the end of the line, so I'll start with Heidi first.
Great, great question. I think just one thing that was really useful from BI's perspective was really co-learning from peers, because we are a DFI and we are part of the European DFI groups, which try to tackle the same challenge of measuring emissions. And we all often, are in different parts of the journey, but there are really like co-learning exercises going on. We have, regular meetings with them to, raise questions, and some might be able to help them out with. So having some sort of a peer group where you can work together, it's really, really helpful. And I think there is also an opportunity from PCAF as well, because there's regional chapter groups and also different working groups that sort of tries to pull people together to really work on the same challenge. I think those are the ones that I would really like to highlight that it's very useful.
Thanks, Heidi. Ian.
I'm an interloper to this question because we don't do finance emissions measurement or management as a trade association, but Eddie and I were talking about this before, and I have exactly the same answer in a way. We run a group of the 7 largest lenders in the UK exchanging best practice on climate disclosures, and I know that their engagement with that group has been incredibly valuable. But maybe I'll add to that as to offer something new. Watch the regulation, and as the regulation changes a lot this year, lots of opportunity to improve practice.
I'm just going to say very simply, start with why. What does emissions measurement actually allow you to do? What are you trying to do? Focus there and let that guide you.
I would say you've got to learn to speak different languages. If you take relationship managers, for example, in business banking, they don't spend all day thinking about financed emissions, and quite rightly. They spend all day thinking about customers. But once you help them understand how to identify risks and opportunities for customers, then conversations become a lot more natural, and I certainly sleep easier at night knowing that they're thinking about financed emissions, but in the right way for them. Not that I go to bed every night thinking about financed emissions, of course. But
Take small steps. When we took our first emissions inventory 5 years ago, I thought we had to try and capture every single asset category, and you soon found out that there was so many different problems that you'd come across, different asset categories, not having information on the right systems, and then trying to create estimates for every single part of the portfolio. We just hit a wall. And I think it's okay to say actually we're going to take this one step at a time and then get management buy-in. So
Thanks, Cecil. So I think we'll probably just wrap things up there. But I suppose if I were to draw one kind of conclusion, it's that some of the conversation we've had today and backstage amongst us, I think there's a real sense of sort of community, and everybody is dealing with similar kind of topics and looking to do similar things. So I'd wholeheartedly encourage anyone in the audience who works for an FI, if you're not involved with the UK PCAF chapter already, please reach out. And just to say thank you to Tushar Bayani and Adi Fairley for helping coordinate this today. But I think I had the signal a few minutes ago to wrap up. So we will pause things there. Thank you very much, everyone.